September 15, 2008. 1:45 in the morning. Lehman Brothers Holdings Incorporated files for Chapter 11 bankruptcy protection. $613 billion in assets. The largest bankruptcy filing in American history, and the single moment that changed everything about how we understand modern finance. But this isn't a story about one weekend in September. This is a story about 30 years of addiction to leverage, addiction to risk, addiction to a lie that Wall Street told itself every single day. The lie that they were too smart to fail. Let me take you back to where this really begins. 1994. After 158 years as a partnership, Lehman Brothers goes public. For the first time in its history, the firm's partners are no longer betting their own money. They're betting yours, mine, everyone's. And that changes everything. When you risk your own fortune, you're careful. You're conservative. You sleep at night worrying about every position on your books. But when you risk other people's money, when your compensation is tied to short-term profits and not long-term survival, that's when the real gambling begins. Richard Fuld becomes CEO in 1994. Dick Fuld, the gorilla of Wall Street. A man so feared inside Lehman that employees would literally avoid riding elevators with him. A man who believed that aggression, intimidation, and pure force of will could bend markets to his vision of reality. Under Fuld's leadership, Lehman transforms. It stops being a traditional investment bank. It becomes a hedge fund wrapped in a bank's credibility. A machine designed for one purpose: maximum leverage, maximum profit, maximum risk. By 2007, Lehman's leverage ratio hits 31-1. Let me explain what that means in terms anyone can understand. For every $1 of actual capital Lehman owned, they had borrowed $31 to make bets in the market. 31-1. Think about that for a second. If those bets lost just 3% of their value, Lehman's entire capital base would be completely wiped out. But here's what made it even more insane. That 31-1, that was the official number. The number they reported to regulators. The number they told shareholders. The real leverage, hidden through accounting tricks we'll get to in a minute, was closer to 40 or even 50-1. Lehman Brothers was a financial nuclear reactor running at full capacity without any cooling systems. And everyone on Wall Street knew it. They just didn't care, because in the short term, that reactor was printing money faster than anyone had ever seen. If you're starting to see how insane this system really is, drop a comment below telling me what you think about Wall Street's so-called accountability, and hit that subscribe button, because understanding these patterns is the only way to see the next collapse coming before it destroys everything. 2006, Lehman reports record profits. $4 billion. Dick Fuld personally takes home $40 million in compensation that year alone. The stock hits an all-time high of $86 per share. Inside the firm, the mood is absolutely euphoric. They're not just winning, they're dominating every competitor on the street. But underneath that euphoria, underneath those record profits and champagne celebrations, the foundation is rotting. Lehman has gone Elon on subprime mortgages. They're not just lending money for houses, they're not just securitizing those loans. They're buying entire mortgage origination companies. Firms whose only job, whose only purpose for existing, is to hand out loans to people who can't possibly pay them back. In 2007 alone, Lehman acquires 5 major subprime lenders, including BNC Mortgage and Aurora Loan Services. These are firms that specialized in something the industry called no-doc loans. No documentation? You want $200,000. Just tell us you make enough money. We won't check, we won't verify, we won't ask questions. They called them ninja loans. No income, no job, no assets. And they handed them out like candy on Halloween. Adjustable rate mortgages designed to have low payments for the first 2 years, then explode 2 levels nobody could afford. Time bombs with a 2-year fuse. Why would Lehman buy these companies? Why would they acquire firms that everyone knew were handing out garbage loans? Because on Wall Street by 2007, the money isn't made in lending anymore. The money is made in the assembly line. Here's how it works. You originate the loan. You bundle it with 1,000 other loans just like it. You slice that bundle into different tranches, different levels of risk. You get Moody's and Standard & Poor's to stamp the top tranches with a tripolar rating. Then you sell it to pension funds and insurance companies and tell them it's as safe as United States Treasury bonds. The machine is beautiful in its efficiency. It's profitable beyond anything traditional banking ever achieved. And it's completely, utterly, systematically fraudulent. Because everyone involved in this process knows these loans are garbage. But as long as housing prices keep rising, as long as the music keeps playing, nobody asks any questions. 2007, the music stops. Housing prices start falling. Not collapsing yet, just falling. Down 2%, then 5%, then 10%. And suddenly, all those mortgage-backed securities that Lehman is holding, the ones rated tripolar by agencies that were paid by the banks themselves, they start losing value. Fast. March 2008, Bear Stearns collapses over a single weekend. JP Morgan Chase buys it for $2 a share with a $29 billion guarantee from the Federal Reserve. Wall Street breathes a collective sigh of relief. The contagion has been contained. The crisis is over. We can all go back to making money. Dick Fuld doesn't see it that way. Fuld sees Bear's collapse as a warning shot across the bow. Lehman is next. He knows it. His top executives know it. And worse, much worse, the market knows it. Lehman's stock, which was trading at $86 in February 2007, is now down to $36, and it's falling every single day. The death spiral has begun. Inside Lehman headquarters, panic is setting in. Not public panic, not the kind you see on television, private panic. The kind that happens in executive boardrooms and emergency weekend meetings that nobody talks about publicly. Fuld starts desperately looking for a buyer. He calls everyone: Bank of America, Barclays, HSBC, private equity firms, sovereign wealth funds from the Middle East and Asia. He's calling in every favor, pulling every string, begging anyone with capital to save his dying empire. Nobody wants it. Nobody will touch it. Because everyone who looks at Lehman's books can see what Dick Fuld doesn't want to admit. The mortgage portfolio isn't just losing value, it's toxic, it's worthless, and Lehman has $50 billion of it sitting on their balance sheet. Here's where the story gets criminal, where it crosses the line from aggressive risk-taking into outright fraud. Lehman's executives know they're in serious trouble. They know they need to show the market less leverage, less risk. They need to convince investors and regulators that everything is under control, that the situation is manageable. So they invent something called Repo 105. It's an accounting trick so brazen, so absurd, so obviously fraudulent, that when it finally comes to light years later, it will destroy whatever microscopic credibility Wall Street has left. Here's how Repo 105 works. Right before the end of each quarter, when Lehman has to report its financial position to regulators and investors, they temporarily sell about $50 billion worth of assets to banks in the Cayman Islands. They call these transactions sales. But they're not really sales. They're short-term loans, repos repurchase agreements. The deal is simple. Lehman sells the assets, gets the cash, reports a lower amount of assets on its balance sheet, and then a few days later, right after the quarterly report is filed, they buy all those assets back at a slightly higher price. Why would they do this? Because by temporarily moving these assets off the books, Lehman can report lower leverage to regulators. They can say, look, we only have $400 billion in assets, not $450 billion. See how conservative we're being. See how well we're managing our risk. It's fraud. It's accounting fraud, pure and simple. And Lehman does it every single quarter for years. Repo 105 moves literally $500 billion off the books at critical reporting moments. Everyone knows it's happening. The executives know it. The accountants at Ernst & Young, who are supposed to audit the books, know it. But they sign off on it anyway, because that's what accountants do on Wall Street. They don't audit. They don't verify. They enable. Summer of 2008. The situation is deteriorating rapidly. Lehman reports a loss of $2.8 billion in the second quarter. The stock drops to $18, then $12, then 10. Short sellers are circling like sharks around a wounded whale. Hedge funds are betting billions of dollars that Lehman will collapse. And they're right. Every single metric is screaming bankruptcy. Lehman's credit default swaps, which are basically insurance against default, are trading at levels that imply a 90% probability of complete failure. Dick Fuld goes on CNBC. He's defiant, angry, combative. He calls the short sellers criminals who are destroying his company. He says Lehman has plenty of capital, plenty of liquidity. He insists that everything is fine, that the rumors are false, that Lehman will survive and thrive. It's not fine. Behind the scenes, away from the cameras, Lehman is burning through its cash reserves trying to meet margin calls. Other banks are refusing to trade with them. Clients are pulling their money out as fast as they can. The death spiral has become irreversible. September 10, 2008. Lehman announces third-quarter losses of $3.9 billion. The stock collapses to $7 per share. Rumors spread through Wall Street that Lehman will file for bankruptcy within days, maybe hours. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke hold emergency meetings all weekend long. Bank of America is still interested in buying Lehman, but only if they get government guarantees like J.P. Morgan got for Bear Stearns. Paulson refuses. He's decided to draw a line in the sand. No more bailouts, no more moral hazard. Lehman will be allowed to fail. It's time for the market to learn that there are consequences for reckless behavior. Sunday night, September 14th, the meetings continue into the early morning hours. Barclays pulls out of negotiations. Bank of America decides to buy Merrill Lynch instead. Lehman has no buyer, no savior, no way out. Dick Fuld realizes it's over. 1:45 in the morning, Monday, September 15th, Lehman Brothers files for Chapter 11 bankruptcy protection. $613 billion in assets. 25,000 employees worldwide. 158 years of history, gone. The markets open a few hours later. Pure panic. Absolute chaos. The Dow Jones Industrial Average drops 504 points in a single day. Credit markets around the world freeze completely. Nobody trusts anyone. If Lehman can fail, if Lehman can collapse, then anyone can fail. Nothing is safe. Within days, the contagion spreads exactly as predicted. AIG, the insurance giant, collapses and requires an $85 billion emergency bailout. Washington Mutual fails in the largest bank failure in American history. Wachovia nearly fails. Morgan Stanley and Goldman Sachs are next in line. The entire global financial system is imploding in real time. Henry Paulson, the man who said no more bailouts just days earlier, reverses course completely. Within 2 weeks, he's on his knees in front of Congress begging for $700 billion to bail out everyone. The Troubled Asset Relief Program, TARP, socialism for the rich, capitalism for everyone else. Lehman's creditors lose everything. Shareholders get completely wiped out. 25,000 employees lose their jobs, many of them losing their life savings that were invested in Lehman stock. Pension funds get destroyed, retirement accounts evaporate, but Dick Fuld walks away with $480 million in compensation that he earned over his years as CEO. $480 million while his employees lose everything. And here's the thing that should make your blood boil. Nobody goes to jail. Not Dick Fuld, not the chief financial officer, not the accountants at Ernst & Young who signed off on Repo 105 fraud, not the rating agencies who stamped garbage securities with AAA ratings, not the regulators who saw it all coming and did absolutely nothing to stop it. The official narrative that emerges is this: Lehman was a victim of the financial crisis, an unfortunate casualty of forces beyond anyone's control, market panic, irrational fear, black swan events that nobody could have predicted. That's a lie, a complete and total lie. Lehman wasn't a victim of the crisis. Lehman was the disease. 30 years of systematically reckless leverage, fraudulent accounting practices, and pure unbridled greed. 30 years of borrowing against the future to pay for bonuses and private jets today. And here's the thing that should absolutely terrify you about all of this. Nothing fundamental has changed since 2008. The banks are bigger now than they were back then. Leverage is back at pre-crisis levels. Complex derivatives that nobody understands are back. The same exact people are in charge of the same exact institutions, making the same exact bets. We call it too big to fail, but what we really mean is too big to prosecute, too big to regulate, too big to control, too big to stop. Lehman Brothers collapsed in 48 hours. But the system that created Lehman, the system that rewarded its reckless behavior for 30 years, that system is still alive, still growing, still building leverage on top of leverage on top of lies. The next Lehman isn't coming someday in the distant future. It's already here, it's already being built. It's just hiding in plain sight behind a different name, a different financial product, a different con. If this video opened your eyes to how the system really works, subscribe and share it with someone who still thinks Wall Street learned its lesson. Hit that notification bell because I'm going to keep exposing these patterns, these frauds, these systemic cons that nobody else wants to talk about. This is why history matters. Not because the past repeats exactly, but because the same people keep making the same bets with other people's money, and when they lose, they don't pay. You do.